Well, hello, ladies and gentlemen. Hello, Canada. Welcome, hockey fans. No, I just felt like I had to do that. So, what a day to start our webinar series this year, and we called it Investor's Guide to Thriving because it's educational focused. What we're trying to do here is not feed you and give you food on a spoon, but teach you how to go fishing and figure things out for yourself and ultimately make better investment decisions. And that's really all about what thriving is. So I see some questions coming in. There's going to be a lot of time for questions tonight. I'm gonna talk a little bit about what's going on in the world these days. I was thinking, for the last few weeks, what am I going to talk about? And obviously, as things got more acute here in Russia and Ukraine, that became the focal point of the market. Will likely be for quite a while here. So with that in mind, I do want to remind you all of all our sponsors and a group of companies that I'm involved with. Everything from managing ETF portfolios to managing stock portfolios, alternative asset classes. If you guys were watched last year, we talked about our ZPay strategy with creating alternative type of income, our private credit strategy, which has absolutely been thriving in this environment compared to what traditional fixed income is doing, and we'll talk about more about that in the coming weeks. And really, at the essence of investing is knowing where you're going, and U Potential is our financial planning division, where really we help you get to where you're trying to go. And for the women out there who support all the great men, and for all the great women out there who are supported by great men, Golden Girl Finance is a tilt on communicating with women about finance, and that should be interesting for all. So thank you again to these group of companies and to our key sponsor, who's been a great sponsor of ours since we really first started doing road shows across Canada for BNN. It's got to be coming on a decade now of doing that. In fact, today is the 15th anniversary of Berman's Call. It was born in late March of 2007. So really, really happy to say we've been doing it for a long time. Really enjoy, communicating with people, trying to make better investment decisions. The world is really a challenging place, and to have a great educational partner like BMO supporting our efforts here are really, really greatly appreciated. And before I introduce tonight's speaker, a reminder to everybody that in support of these events that we do, fundraising is really important to us. Sick Kids Hospital does tremendous work with kids all across Canada. It's a global leader in solutions for children's healthcare, and in particular, the wonderful work they did to save the life of my very good friend and business partner, Jared, who normally does these introductions, but was called away on family duties tonight, no doubt with his kids, that he's able to enjoy that still. So Sick Kids Hospital and Dementia and Alzheimer's Research at Baycrest. One of their sayings is if you don't have your mind, you're not you. And it's the essence of life, really, is your memories. And so it's a great effort they put in to helping people live better, and research they're doing to try to delay and change the outcome of Alzheimer's and dementia. So really, really great. And if you can, please support one of our charities. If you're enjoying the series, if you're getting something out of it, if you're learning, dig down deep and help us out with either one, and we'll be thrilled to match your donations. And so with that in mind, I'd like to introduce our speaker tonight, Saad Rana from BMO ETFs, who's going to take you through the BMO toolbox to help you do your own research. So Saad, over to you.
Excellent. Thank you so much, Larry, for having me on today, and congratulations on the 15 years. That's quite awesome. And good evening, everyone. My name is Saad Rana, BMO Exchange Traded Funds. I am so glad that you took the time to join us for today. I'm very excited to be here, and I wanted to recognize, just the great partnership we have with ETF Capital Management as well. And, we are also here really thanks to you, the investors. So right off the bat, we have our disclaimer there on this slide, and just trying to say that we're not going to be providing any specific advice today, nor any specific recommendations in this session of mine. What we are really trying to do, though, is give you some insights into the overall market and focus more on the tools to help you do your due diligence to invest in these market environments. And I also wanted to just give a little bit of attention to this slide here for BMO Exchange Traded Funds. Now, in 2021 alone, more than $50 billion flowed into ETFs, lifting assets under management to over $3 billion in Canada, which is phenomenal, and it's continuing to grow. Now, BMO ETFs makes up for 26% of this market share, and I'm very happy to report that we are yet again #1 in Canada for net new assets, 11 years in a row. But not only that, we are also the #1 ETF provider for fixed income and smart beta solutions in Canada, and this is based on AUM. And we also look forward to growing not only our market share, but overall education and use of ETFs within Canada. Now, on the note of markets and overall volatile environments, such as the ones we are currently facing, I wanted to just let everyone know that ETFs have been battle tested through many types of crises, before, and the current crisis is not very different from that, in the sense that, they have been tried and tested. So I thought it would be very good to quickly run through some tips for those of you who want to invest in long-term for the ETFs. And we'll be looking at our ETF trading tips. It is important to be aware of market conditions when you're trading, placing trades on ETFs, but also looking at the underlying exposures that could impact your trading activity. So I would encourage you to consider these tips when buying and selling ETFs. And the first one on our list here is that we want to avoid trading at the open and close of the market, more specifically within 10 to 15 minutes of open and before market close. Now, this is important because market makers are looking at the underlying portfolio at market open and what it's trading at and finding the price. So this is known as price discovery. Similarly, in the last 15 minutes of the trading day, market makers will close their books, and this could affect wider spreads, which can lead to volatility. Now, the next point there, we also want to ensure that placing trades are done via limit orders, especially in these volatile times. So a quick note to consider is also that stop loss orders become market orders. So it is up to you to decide if that's what you want to use as an order execution, but I would suggest to be very cautious of that. Limit orders are the way to go when you're wanting to trade the ETFs. And our next point here is to consider, when you're trading ETFs, you have to look at when the underlying market is open. Now, this is important because when markets are closed, the market makers cannot perform their function, which can cause the spread to become wider. And lastly, our last point there is that in markets such as these, where there can be considerable volatility, one should expect the spreads to widen for any security, not just ETFs. So we should always circle back to when we're placing an order, we place that limit order to ensure that we're getting the best price for ourselves. And if we move on to the next slide, we'll jump straight right into it. As I mentioned earlier, we'll be going over the tools available on bmoetfs.com. That's where you can go and access all of these tools that will help you do your due diligence. And looking into some of them, that are provided on our public website, which is, by the way, all absolutely free for you to use. I'll give you a quick overview of what these tools are, what they do. And then we'll actually spend some more time going over the comparison tools specifically for tonight. Now, these tools do provide a lot of data because we are covering a lot of ETFs and all the ETFs and funds in Canada. This will allow you to do a detailed due diligence on your end. We have data on over 1,000 Canadian listed ETFs and mutual funds. So the three key tools that we have available are the comparison tool, our screener tool, and of course the build a portfolio tool, also known as our proposal generator. And on our next slide, we get a quick snapshot of the comparison tool. So it's a fabulous resource. If we go to the next slide, we'll see that little recap of the comparison tool. And it's a fabulous resource, for investors at home to look at any 5 different Canadian listed ETFs or Canadian available for sale mutual funds. Now, this tool just streamlines everything for you. You get all the data side by side on 5 different funds, things like performance, data, top holdings, you can get trade metrics, risk metrics, etc. The list goes on. And we will be doing, as I said, a deep dive on this and a walkthrough of this tool specifically. It's a great way to get all this information, download it to your computer. You can save it as a PDF or to your device, have it at your fingertips. Great way to compare funds. And then on our next slide, we see our ETF screener tool, or better known as a stock replacement tool. And the great thing about this tool is that it actually helps you find a stock that might be built into a specific ETF. So you can type the ticker that you want. It'll provide an ETF that has exposure to it. And it's a great tool for you to use when wanting to figure out, the different types of exposures in your portfolio and which ETFs might be needed to fulfill whichever needs you need for that exposure. And then the last tool that we have available that is on our website is our portfolio generator. It allows you to build portfolios and review how they would have been performed over different frames of time using historical data. And it is also very useful to optimize allocation with, our different charts that we have available for allocation and also performance. And going on to our next slide, we'll jump straight into the comparison tool itself. Now, what you'll notice here is the first thing you'd want to do when you come on this landing page is on the left-hand side, you see enter fund or keyword. You can type in the actual ETF or fund name or ticker. And then when we go to the next slide, you'll see basically what happens when you start typing. On the next slide, it will show on the top left-hand side that we're in the midst of writing in ZAG. And right below it, there's a pre-populated option for you to just click on ZAG. It's great because you can even type the name of the ETF or fund and it will pre-populate whatever you're looking for. And we'll also notice on the right-hand side of this specific slide on that image, you now have 5 ETFs listed side by side. And this is great because you get all the data right in front of you in one place rather than having to sift through many pages. So if we go to the next slide, there is a lot we can look at when using the comparison tool. So after you've entered and selected your 5 ETFs, the first section that we can see is the price data tab. So you would click on the tab, it would expand. And after you've entered this and you've expanded it, we get to see different types of information. So the first thing is the NAV, which is known as the net asset value. Then you see closing price, also known as market price, and the one-day change in dollars and percent of each holding. And just going back really quickly to give you a little understanding of what the ETF market price is. It's basically the price at which shares in the ETF can be bought or sold on the exchanges during trading hours. And then whereas the NAV or net asset value for an ETF represents basically the value of each share's portion of the fund's underlying assets and cash at the end of the trading day. And this is what differentiates the mutual funds from ETFs. ETFs have a price throughout the day as they're being traded on the exchange. Now, if we go to the next slide, this will be our fund information tab. And within this tab, there's a lot of information that you have access to, all sorts of relevant details. For example, the exchange that the ETF is listed on, equity fund style, credit quality, asset class, management fee, etc. Like the list goes on. But I also did want to highlight, when one is looking to compare ETFs here, it is really important to look at the ETF objective, which is listed in this section, and really understanding its strategy from there. The objective will say exactly what the ETF is setting out to do, and this will give an investor, the indication on whether the ETF is tracking an index or if it's active. The index may also be listed in the objective portion. The index is usually always listed in the strategy section, and the strategy usually tells you as the investor how this ETF is going to meet its objective. A few of the ETFs that we have listed here are tracking an index, and you can see that right at the bottom under index/benchmark. It's always helpful to research more information on the index. So you would go Google it, go to the index provider's website, get more information on that specific index for yourself, so for your own research. But this is a first consideration when we're getting to know about the differences between ETFs. Now, another consideration is to know your fees. There is MER, management fee. So management fee is the fund provider's charge to put that portfolio together, to rebalance it, kind of the day-to-day maintenance of the portfolio, and the investor doesn't have to do that. MER, on the other hand, usually has a tax added as well, so 13–14% higher than the management fee. And the last thing that I wanted to mention about the fund information page, in the event that you're comparing fixed income, so in our case here, the last listing we have on the right side, ZAG, fixed income, you get to see the credit quality. And this is also often a consideration for most investors when buying fixed income. So just something to keep in mind when you are doing your comparisons. In our next slide here, if we go on, we see that we have the performance tab, and it's a great visual representation of how the ETFs or funds are performing. We have the option to select performance based on the 1-year, 3-year, and 5-year numbers, as well as common inception, which basically is the common start date of comparison for the most recently listed fund or ETF. A thing to note is that the growth chart on the left-hand side here is cumulative, and the bars on the right-hand side are annualized after 1 year. Now, these bars also show a little bit more additional details. So, you get to see year-to-date return, 1 month, 3 month, and 6 month, as opposed to the graph, which has 1, 3, 5 in common inception. And then if we move to our next slide, which is our fund data slide, tab rather, this shows us the overall number of holdings in each ETF and fund. It will also show us the trailing yield of the last 12 months, distribution frequency, which is also important, especially if you're looking to get, collect regular distributions. In the example here, we have quarterly or monthly, so quarterly for broad-based ETFs and then monthly for the covered call high yield ETFs. And then we also have information on YTM, again, for fixed income. YTM is our yield to maturity, the total return anticipated on a bond if it's held until it matures. So that's why it only shows for ZAG in this case, because the rest of them are equity based. For fixed income, duration is also very important. So some want short, others may want a longer horizon, 8 years, such as in ZAG's case. Duration can have an impact on fixed income returns. So that is definitely something to consider when you're holding fixed income and comparing them. And then if we go on to our next slide, we see our holdings tab. And under our holdings tab, we get a lot of information about the makeup of the ETF or the fund. The top 3 holdings by percentage, sector breakdown. When we're looking at sectors breakdown, when we're adding different exposures, we need to be aware of how that can affect our portfolio. And what may be favorable based on the current market conditions or not. So again, something very important to look at. And then we also have geographic exposure, which isn't shown in this specific screen, but it's also available. So, you know, if you're looking to get more Canadian exposure, US, or if you're looking for global exposure, that is a great section to give you all that information. And then the next slide that we have here is basically our ticker hyperlink. So in any of those comparison of the ETFs that we saw, if you clicked on any of the tickers, it would open up this page for you, which would give you additional details about that specific ETF, like a fact sheet equivalent. And you can download the profile on the right as a PDF. So you have all that available. And once you've populated your overall comparison, you can download the whole comparison as a PDF as well, and have that saved to a computer or, you know, on your devices. And from here, just the last slide that we have, I wanted to just take a moment to tell everyone about etfmarketinsights.com. Market Insights webinars focus on you, the investor. They're a great source to better educate you on current investing topics, you know, themes and ETF investing for the future. There's a lot of research reports and information that's free of, you know, freely available there for you for your educational purposes. Market Insights runs weekly on Fridays at 1 p.m. Our session for this Friday, which is tomorrow, is smoothing out the ride, focusing on low volatility and dividend ETFs to mitigate volatility, which I think is really well timed for our current circumstance and the crisis that we're seeing happen. It is hosted by none other than Danielle Nezel, and she'll be joined by our portfolio manager at BMO ETFs, Chris Heeks. I definitely encourage you to join us. You can register for free by going to the URL www.etfmarketinsights.com. We also have an exhaustive library of our past recorded sessions for you to experience at your own pace. So I highly recommend everyone to visit there. And with that, I'd like to conclude my portion of the presentation. A special thanks again to the ETF Capital Management team, and I'd love to hand it over back to Larry.
Well, thanks very much, Saad. And those of you who were around last year for the series, you'll know Chris Heeks and Danielle are great experts in the ETF area. Chris helps run the ZPay ETF. I've seen a couple questions already coming in tonight on that, and we'll get to all of those. I've specifically cut my formal talk down tonight so that we'll have more time for questions. And given market circumstances, I think there'll be no shortage of them. So just a quick show of hands from people. I think you can do that voting kind of thing on your terminals there. How many people do watch on a regular basis what we put out on YouTube? We're just kind of curious to see what the interaction is, and should we continue to do this? Should we not? Is this the right place to host our educational material? So, you know, any feedback you can give us would be terrific in that regard. And if you're not following us on YouTube, then you know, look for us there. It is the repository at the moment for all our educational material, including my weekly look at the market radar. So here we go in terms of the evening, and really I plan to spend an hour going through all the macro risk factors of the PRO-EYES indicator. The PRO-EYES stands for Probability Return on Investment Index, and II for Investment Index, and we just nicknamed it EYES, and you think it's a pro looking at the market and EYES. So that's been out there. Do a Google search. If you don't follow it, you probably should. Yeah, I did my CMT paper on Chartered Market Technician paper back in the mid 90s, and I created a model like this to look at the bond market actually. And when I was at CIBC World Markets as a strategist, and when they asked me to take over the equity side, I created this model to look at the tactical, and I did a weekly report on it, macro factors, tactical. It's evolved over the years and finally got around to publishing it on a regular basis. So there's three components to the market, to the model that I want to talk about, and that is the valuation piece. So what is equity markets telling us statistically about valuation? And for the most part, valuations are still pretty high, but because we've come off considerably, more than 10% from the recent highs, the risk levels are lower. These indicators were in the very, very high 90 percentile. Some of them were at 100, meaning all-time, lifetime, in terms of valuation. So we had been concerned about the market. The higher the risk level, obviously, the more concerned we are. The 50% of the model is no, not 50%. You have 20 indicators, so 40% of the model is weighted towards valuation and business cycles, so the core fundamentals on a macro basis and what they're telling us about what's going on. And then 60% is the tactical, meaning the technical factors. And you can see there, we look at sentiment indicators from put call ratios to the speculative position in the E-mini futures, how far we are from the key 200-day moving average, investor sentiment. Excuse me, I need a drink here. Seasonality patterns, the presidential cycle, and then the current year of the presidential cycle. And then we look at volatility, two measures. What is volatility relative to average? What is volatility on the futures curve itself? So current volatility relative to future volatility expectations. Market breadth, three indicators on market breadth. It's that important. Percentage of stocks above their trending average, intermediate, long term. And then the summation index that Sherman and Marion McClellan developed back in the 1960s that their son Tom now manages and updates. And we were so oversold on market breadth. When these things are under 10%, you're really talking about a deep oversold condition. The 13-week RSI index hasn't been this low since COVID. So the tactical factors in the last week or two have been very, very attractive. Seasonal patterns right now, kind of neutral, but I do want to point out in the commentary that we write every week on these, the second year of the presidential cycle is the worst year of the 4 years for returns. So, we're in the point now where, growth is turned down and slowing. The risk factors there, the best of growth is behind us. So the leading indicators are telling us they're really high risk factor right now, and we're going into a downturn. Now, the slope of the yield curve, credit spreads right now, very neutral, very stimulative, not flashing any strong warning signals. A yield curve inversion is a really, really bad sign that, we're heading into a recession, and we don't have those yet. But as we get into the recession, that's where the opportunity grows. So from a valuation standpoint, we're neutral. From a business cycle standpoint, we're neutral. From a trading standpoint, we're oversold. And therefore, the overall Pro-I series, if you're familiar with the fear and greed index that CNN produces, this is a much, much better version of that. Not only does it incorporate the factors that CNN has, but it looks at the business cycle factors and the valuation factors that CNN does not look at in their indicator. Now, you can see that when we dip into the green area, which is below the median, the middle 50%, we're in the opportunity zone. What we don't know and what we'll never know is how low does it get, right? And you can see that at the depths of COVID, this thing got down to about 25%. At the depths of the first tranche of the European debt crisis, a decade ago, we got down to similar levels. So, when oil prices were coming off, we got down to the mid 30s. You can see that in 2016. When we were worried about China in 2015, and we had the currency risk off for China. You remember that period where Monday morning the Dow opened down 1,000 points. Back then, 1,000 points meant something. So that was mid 2015, and you can see the indicator got down to about 40%. In the double declines that we saw in 2018, where we had at the beginning of 2018, we had the risk off event where the volatility futures blew up and a lot of those ETFs had problems trading volatility. And then ultimately when the Fed was tightening and causing the yield curve to invert towards the end of 2018, we got into much more oversold conditions and again got down into the 40s and upper 30s as a level for the indicator. So, where we are now, there's opportunity from a tactical perspective, but I would say that in context of we're only at the very, very beginning and the Fed actually hasn't even raised rates yet of the, the downside of the curve. And so I would expect us to be very choppy. I would expect failed rallies in general. Don't look for new highs here. A relief rally, absolutely. I'll talk more about the Russia-Ukraine situation and some of the geopolitical factors shortly. But from an opportunity perspective, there is some there. For us, we covered our hedges. We're a little bit longer than we would otherwise be at this point. But if we rally a couple hundred points on the S&P, my inclination would be to add more protection to the portfolio, like we did, only a few weeks ago when we bounced to about almost 4,600 on the S&P from the January oversold condition, which was in the low 4,200s. You'll all know we broke those levels overnight and into this morning, and by the end of the day, we made a big reversal. So, the opportunity was there, and today was a good day to put some money to work. Is this the end of it? I don't think so. When we look at just the tactical factor, okay, so this is just the technical inputs, not the macro, not the fundamental valuation. The levels that we were seeing only a few weeks ago to start the year were very highly cautionary. And as we do get pullbacks and corrections, that's when the opportunities. So again, we never know how low the indicator is going to get. We never know how long it's going to last. That's not what the indicator is about. It sets the environment for us to look for things. So when we're in the cautionary areas, you look to take profits. You look to be more defensive. You look that if you're going to buy something, you buy something that's less sensitive to the economy. When we're in cautionary territory, you shouldn't be buying high PE growth stocks because when the market's correct, those are the ones that are going to get hit the hardest. I remember a year ago, not dissing the ARK ETFs, but suggesting that there was a bubble there. At the same time, I was suggesting there was a bubble in Chinese internet names. And people were writing in hate mails because they didn't want to hear it. It was going up, and the meme craze was people were buying stuff for stupid reasons, not fundamentals, but because you could buy it with an option, and the gamma trade forced short squeezes and markets moved higher. Those are not reasons to invest. They're trading reasons, but I'm an investor, right? And as much as tactical as I am, as much as I promote trading and rotating and rebalancing, it's not about trying to time the market. It's about trying to make that better decision. And to me, this tells me what to think and what to look for. And I'm sharing it with everybody, and I think it's really a great tool to set the groundwork. So in the last few weeks, we're looking for opportunities to buy. It gave me opportunities to buy 2 days ago and 3 days ago, right? But what's the level? Do we need to test support? And this is where you take an indicator like this and you say, okay, there's the January low sitting there, and we're sitting 150 S&P points higher. Do I buy today, or what's the probability of us testing that low? Given what's happening, and we're about to go to war with Russia. And what does that mean? And so at a very minimum, you think there's a high probability that we're going to at least come close to that low and test it. But yet a headline comes out, and all of a sudden, no, Putin's willing to talk, and S&P's ripped 2% in the next hour and a half. And so again, that's the difference between being a day trader and looking at the minute by minute charts and being an investor. And most of the questions we get, on here and on Berman's call, it's less about trading and it's more about investing. Larry, should I buy this now? That's the flavor of every type of question we get. And and I always try to couch it with the idea that I put on half a position, I put on a third of a position, I put on a full position, and this is my guiding light here, and it really helps me navigate the size issue. How much should I put on from a macro perspective? When it comes to the micro, that's about the individual stock, the individual sector, ETF that represents that sector or that market. And with the S&P 500 being the benchmark of the world, all eyes look at it. It's the most liquid, most traded, derivative, easiest to hedge, biggest part of the world index. I focus on it. I don't look at the TSX very much. It's 3% of the world. It's heavily weighted in a couple industries. Banks, we know, energy, mining, and we don't have a lot of the future. Canada has very little healthcare, has very little, healthcare, stent manufacturers, biotech. Like we have very little of that. And so our healthcare sector right now is a bunch of wheat stocks getting whacked in the head, waiting for the US to pass banking reform so they can legalize it federally. And it's supposed to come any day now in a bill that, well, Biden's getting close to being a lame duck here. It looks like he's going to lose both houses of Congress. So unless they can get it into a bill, that might not work out. And anyway, so that's the macro and the micro, bit of it. So let's get into Putin on the risk. I hope nobody's offended by the play on words there. I'm a big Fred Astaire fan. I love the old musicals. I love musicals in general, but I couldn't resist the play on words there. So, Putin told us in his sociopathic narrative the other night that he wants the USSR back. He wrote a year ago, not quite a year, July of 21. If you Google Putin's English blog, you can find his narrative there. And he basically said he wants it back, and his legacy is going to be rebuilding the USSR. So that doesn't include any NATO countries, but part of what was the Eastern Bloc, Estonia, Lithuania, like those are out of reach. But Kazakhstan could be next. So when does that happen? Next month, 6 months from now, 5 years from now? Who knows? But as sociopathic as this guy is, he's also not an idiot. And he's got the upper hand here. He's got the leverage over Europe that, listen, 40% of Europe's energy comes from Russia. It's that simple. And so, the spike in natural gas prices in Europe and inflation pressures, Europe's heading for a recession. The whole ESG investment, and I'm a big supporter of the ESG movement, I have to say that, but it's got to be done now, and you got to stop using carbon now narrative is really caused some unintended consequences here, because big oil, because their cost of capital has gone up significantly, is not reinvesting. They're hearing from investors, pay us back, buy back your shares, increase dividends. I don't want you drilling for new oil. I'm not going to reward you for that. So they haven't. And so oil prices may very well stay elevated. And the world doesn't work well with $100 oil. It's a tax on every single person that uses plastic, that uses food that needs to be delivered, and so forth. Never mind driving your car and heating your home. High oil prices hit everything, and probably for the foreseeable future, oil prices are going to stay elevated. Now, when the next recession comes, we'll get a big correction. From what level does that start and where does it end? Well, story for another day. So, Putin's got the advantage here. You're going to see the US do a deal with Iran on the nuclear just to get their supply of oil back into world markets. The US is dealing now from their heels. Obviously, Biden's never going to say that. You're never really going to hear that in public. But China's move into the central bank digital currency. What this means is effectively that, and I'm quite sure Putin, when he went down to the beginning of the Olympics and met with Xi, had a deal where if they cut us off from selling our wheat and gas and oil, what's your bid? And Xi said, we'll take all of it, right? So, from a revenue perspective, I don't think Putin cares. I think he's got a buyer for as much as he's willing to sell. And so, this empowers the anti-democracy movements in Russia and China, and again, central bank digital currency. So if China perfects this, it doesn't matter if Russia gets pulled off SWIFT, because they can now use the digital central bank deposit that they would have as a reserve currency in the Chinese renminbi, and all good. Putin sold just about all his US dollar debt in reserves and bought gold with it. He's a pretty happy camper, these days, with oil prices where they are and everything else. So, you have the US now in an uncomfortable position. Biden's a lame duck. Congress is almost certainly going to switch. And that means no spending. And, you've got a fiscal cliff coming. You've got central banks having to fight inflation. Stagflation is on the front burner. And and as the longer this new Cold War lasts, which is currently a hot war, and the more aggressive Putin gets, he's not going to attack NATO. because that is mutually assured destruction with nuclear weapons pointed at each other. So I don't think we need to worry about the US and NATO going to war, hot war. I hope not. It wouldn't be a black swan because there's a lot of eyeballs on it, but it would be a game changer in terms of what it means. So, I Putin tries to get back and reassemble what before the wall came down. So let's see here. So question time. So let me get into the ones that people wrote into, and then I'll get into the online ones. And we have a good 45 minutes to get through all those. So gold. So let me bring up some charts here, and we can have a look. And let me blow them up so everybody can see. So crazy move today. You can see the bar here on gold where, at one point overnight, gold was 1975 almost at the high, and at the low today sold off aggressively. So you had a close to $100 range in gold, but I can't see gold being sold off aggressively here. I get that you sell it, you raise some cash, and maybe you throw it into some oversold stocks, but I think gold has a case in a stagflationary environment here to do actually quite well. So I'm not bullish on gold because it's been a very frustrating trade. I have a position still. It's less than what it was. Every one of these rallies that we've seen over the last year, I've been selling into. We lightened up here, but we bought back in, we lightened up, and we traded around. Gold stocks remain some of the cheapest assets on the planet, but because there's value there, but there's also the core belief that gold is transitory. And if inflation persists, as I think it's going to, John Deere, big manufacturer in the States, just did a unionized contract for 5 years where the average increase over 5 years was close to 30% with bonuses and top ups. And so you're going to see every other union look at that number and say, I want that and more. And wage pressures are they're just coming. And so yes, a lot of these spikes will be temporary and they'll correct, and the rates of change will, you're not going to see oil prices keep going up 30 or 40 or 50% a year, and car prices can't keep going, used car prices can't keep going up that much because there's a limit, because over new car prices, and I guess if you need one, you need one, but at a price it doesn't make sense anymore. So your rates of change are going to slow, will come off the boil a little bit, but inflation is going to stick well above where the Fed is comfortable with, and central banks in general. We heard the Bank of South Korea come out and say inflation is going to be sticky above 3%. First central bank in the world to actually say that. But you heard from some Fed speakers today, given the geopolitical risks, they didn't really say that. Tightening financial conditions. So when you look at financial conditions index, it's largely credit spreads and the S&P 500. And that makes up the bulk of financial conditions. So when there's stress in financial markets, the Fed is not going to aggressively fight inflation here, and that could make it stickier too. So what the Fed can't do here is ease. What the Fed can't do here is more QE. That would make the inflation problem worse. So you've got a central bank that's not impotent, but severely wounded in terms of coming to the rescue. And you don't have fiscal policy either because, Biden's a lame duck and Congress can't get their stuff together to pass much needed infrastructure spending, right? Like they need to spend a couple $1 trillion over the next decade minimum, and they can't get their act together on that. Now, it's largely due to the leftward swing, and they put a lot of stuff in there that's not infrastructure, and so again, debate for another day. So that's gold. Next question. We saw Royal and BMO were impacted a bit by the war today. Do you see possibility of a wider threat of collapse in central banks globally at all? So no. I mean, there's a lot of conspiracy stuff out about central banks, but I'm 100% convinced that governments will always control the money supply, and central bank digital currencies will be the future. I believe they'll tax and they'll just make the independent cryptocurrencies very expensive and difficult. And I think over time you'll see money leave there, not go there. And people who are supportive of that, I get the arguments, I really do. I have a different view, and we'll see what the future brings. In the meantime, have fun trading them, but they're not really investable, and the HODL guys to me are foolish. It's really it's a meme nonsense thing, and you really shouldn't think that way. Trade it for sure. It's a tradable asset. It's volatile if you like volatility. There's plenty of liquidity now through ETFs to trade these things, and have fun with it. But don't think about it as an investment. So I don't see a collapse in central banks. I do feel that we are coming to the end of the U.S. dollar as the reserve currency of the world. And I was talking to a geopolitical strategist actually just this week, and he opened my eyes to the Chinese central bank digital currency and what the implications would mean for SWIFT and for global trade, avoiding the US dollar. Taking Russia off SWIFT would impair their ability to get paid for their commodities through the banking channels. And, sanctions on banks and freezing accounts and all that, that goes a long way, but it's you understand global trade and everything else. You understand that the U.S. gets 20% of their uranium from Russia. So can they actually afford to stop that? And the answer is no. Can Europe afford not to take energy from Russia? No. There are no good outs there, and that's why the West is actually on its heels right now. And I've been asked recently, will that embolden China to take Taiwan and to be more aggressive there? And I think you will see far more posturing. You'll see more ships in the harbor, but the big thing, the next couple decades, and China knows this very well, is technology. And it's technology and robotics creating jobs, helping people do their jobs better, biotechnology making us live healthier and longer, and that's the future. And you have to be an expert in that area to be a world leader, going forward. And China knows that, and everybody needs semiconductors. And right now, the vast majority of supply in the world comes from Taiwan. And breaking that supply chain through a hot war is just not in anyone's best interest, and China knows that. So China does have that in mind, make no mistake about it. It's probably in the 5 to 10 year window would be my best guess at the moment for when that becomes a front burner issue. And so, think about that a little bit. Chinese tech stocks are dirt cheap compared to the US. And I get there's all kinds of issues there, but there's all kinds of markets for them to grow into that doesn't have to include the US, consumer. Where on the flip side, if China closed the door to Apple iPhones and Macs and replaced them locally, which they could do, some consumers may not be happy, but the 25 million iPhone users in Russia right now, if these sanctions last a few years, that's 25 million less iPhones that Apple's going to sell in the next few years. So what does that mean, right? If China did the same thing, Apple trades at $50, right? I don't know. I haven't done the math on that, but it's lower. It's not 30 times earnings, it's 20 times earnings and a lot less earnings and so forth. So that those risks are sitting out there, and I think about those a lot. That has nothing to do with banks and central banks. So I got way off topic there. Could a prolonged period of conflict in the Ukraine and economic sanctions against Russia lead to increased inflation and combined with slower economic growth and eventually stagflation? So I did mention that. I do think that risk is significantly increased. Someone commented on the chat that deflation is more of a risk. And yes, demographics and debt measured in the long term, absolutely, deflation is a risk. But make no mistake, the driving force here on stagflation is supply chains coming home. It's going to be more expensive to produce those just-in-time inventories at home, where we can't rely on global trade as much, and the unwinding of some of the globalization since the wall fell in 1989 is here. And that disinflation and falling rates that we had for a couple decades is in the rearview mirror. Rates are already there. We're at zero. We were negative rates. So deflation with all the debt, absolutely, as a thematic, but we're going to go through a period here where wages neutralize, capital share of income is lower, and labor share of income goes up. It's going to be voted in. And what I mean voted in because people are going to vote for policies towards higher taxes, not because they want them, but because that will allow governments to have more benefits for companies to raise their prices so they can pay workers more. And it's coming. So margin pressures are coming. Anecdotally, and purely anecdotally, one of my good friends is in the food distribution business, big manufacturer. Walmart is one of his biggest customers. He put in 2 price increases in the same year to Walmart, and they didn't say boo. And Walmart, you try to raise prices on Walmart, and they look for another supplier. So it's anecdotal, I know, but it's meaningful. And everybody's recognizing the supply shortage cost push that's going on right now. This is not increased demand creating inflation. These are supply channel issues that will get resolved. It's going to take time, but the wage pressures and getting people back to work, and they're just going to start paying people more money. And I think it's coming. So, that's a big part of this. A year, 2 years, 3 years, I don't know, but stickier than the market thinks. I have a significant ZPay position in my TFSA, but it's still a good option given the Russian-Ukraine tensions and planned rate hikes from the Fed. It seems U.S. large caps are at risk, which is what's held in the fund. So here's the thing. Do you need the 6% coupon to live off of? If you're clipping that coupon because you need that, let's say you put $1 million in there, I'm just rounding numbers, and so you get $60,000 a year and you're using that to live off of. If you go to cash, you're safe, but now the 6% goes away. And you can eat into the capital and take that 6% from your cash to live off of. So this is a financial planning exercise. It's not about markets. This is about who are you and what do you need it for, and are you living off of it? How old are you? What's your TFSA for? To me, totally for speculation account. This is not where you put defensive holdings. This is where you put your big bet. This is where you put your favorite stock for the next 5 years or 10 years. This is where you put your growth, because when you hit that home run, you're never going to pay tax on it. Now, if you're at the place where, this is a good way to get distributions that you're not going to pay tax on, then that's fine too. So it's hard to answer. Are U.S. large caps at risk? Absolutely. I think from a recession standpoint, we need a policy mistake from the Fed. And what I expect now at the March meeting is a massive walk back on the path of rate hikes. When they say dependent, they're going to say, not only are we dependent, but we're watching this and this and this and this and this, and are going to totally downplay the current inflation. And so you're going to get a very, very dovish Fed who, for the last few months, has been very, very hawkish. Everybody's been, but this is a game changer. This new Cold War that's now a hot war is going to feed inflationary pressures. And if they tighten into a slowing economy where there's no more stimulus coming, we have a problem. Yeah, we're reopening, jobs are coming back, all that is fine. But wage pressures, margin pressures, cost pressures, if you have to pay more for your gas, your house heating, your plastics, your food, that's less for discretionary spending. That's bad for earnings growth. And you have a market probably now for 23 and 24 where you see no earnings growth at all. Priced into the market is 10% earnings growth a year. So what needs to happen for that to be priced out, and how does it correct? Well, if we have a tete-a-tete where Putin's threatening NATO states and he moves his troops up to the border with Poland, he could very well do that once he takes over Ukraine, right? I don't know what's on his mind. I think he just wants to take Ukraine and bring it back in and let things consolidate, let the dust settle for a couple years, and then sometime down the road, when the right situation presents, he might go to Kazakhstan and so forth. So that's been the pattern. I can't expect it to change at this point, but again, I don't think he goes hot war with NATO. And so again, going back to this point, how do markets correct? They correct, but the Fed is going to be easy. They were going to make a policy mistake 2 months ago by over tightening into a fiscal cliff, and now I think they're going to be very easy. How easy can they be is going to depend on what happens to inflation pressures over the next couple of quarters. But there's a real risk here. Now, the yield curve isn't inverted. It's very flat at parts, but we're not there 2s to 10s. We're not there 3 months to 10 years. We're not even close. And it's typically not until a year to 2 years after that inversion that the recession would happen. So, it's a couple years out at best right now, and I don't think we need to price that in or worry about it too much. What's the downside risk? If earnings stay where they are for the next 2 years at $220 for the S&P, 225, and we're not in a recession, so no growth but no contraction in earnings, the multiple works its way down. 220 times 20 multiple is 4,400. 220 times 18 multiple, you got 4,000. Times 16 multiple, you got 3,600. At 16, the market starts getting dirt cheap again. So, probably not a whole lot of downside if earnings remain stable. But if we go into a recession and earnings are going to take a hit, multiple contraction, earnings contraction, much deeper equity market downside. That's what we have to weigh when you're asking your question about ZPay and should I hold it now. And so right now it's fine. I wouldn't worry about it too much. It's a great defensive holding if that's what you're looking for. There's going to be some volatility there because you're short volatility when you're writing premium. And as VIX goes up, being short volatility works against you, but it also increases your yield. So keep that in mind too, because the yields will be juicier as volatility goes up. Okay, so that's it for the questions that were sent in already. So will financial sanctions impact North American banks much? So I talked a little bit about banks, far more centric to European banks. I've been overweight those banks. I haven't trimmed them yet, but likely to trim back. But European banks are still some of the cheapest assets on the planet. So, I'm not worried too much about it at this point. There are some that would have, Russian debt exposure. The U.S. announced today that, basically all Russian debt is worthless to them and they can't finance anymore in the U.S. And so, what are Russian U.S. dollar bonds trading for? You see your emerging market U.S. dollar bond index under stress. Probably a short-term for trade buying opportunity, but I don't think we have to worry too much about a global recession at this point, or a recession in Canada that would far more impact Canadian banks. As risk sentiment goes, the banks will go up and down, but we don't have to worry about solvency or any of those things. Larry, COVID didn't reset the market. What's your view on war, inflation, and raising interest rates and market rips? And so, I think I covered a lot of that. Numbers show. Oh, so here's a question that in response to something that Saad had said in the BMO introduction on their tools. He mentioned don't buy at the open and close, and JD writes in and says the numbers show buying at the market close and selling at the market open has a better track record than the reverse. This is absolutely true. The vast majority of the change in valuation for US markets happens overnight. It's a bizarre thing that if you buy the close and sell the open every day, versus doing the opposite for the last 20 years or so, you have no return at all if you're buying the open of the US market and selling the close. But if you buy the close and sell the open, you've got like 15, 18% a year or something like that. It's a staggering number. So JD, that's probably what you were referring to there. in that question. But what BMO was talking about was market liquidity and limit orders and getting good fills. And, you know, when all the stocks underlying the ETF aren't open yet, which is in the first 5 minutes, not everything's open yet, you get wider spreads, so you get worse fills. So that might be, you know, what you were saying there. Can I outline what return of capital in my funds and return of capital, how it affects distribution? So there's a couple different types of return of capital, and it has to do with trading gains and losses, realized, unrealized. It has to do with new money coming into the fund and going out of the fund, and all kinds of things not related to market performance. So when you have those issues and you get a return of capital, that's related to what's going on within the fund. When you have a return of capital where not everything in the fund itself in terms of yield is generating, let's say 3% by way of dividends or interest payments or whatever is generating the yield, premium on options. So let's say that part is generating 5%, but the fund has got an 8% payout. 3% of that is a return on capital, which is you getting your money back. So there's a good rock and there's a bad rock. You getting your own money back to boost the yield is the bad rock. You getting your own money back because of flow of funds that have gone into the fund and out of the fund, that is a good rock. It's not a bad rock because it's not fake yield. Okay, so that's the difference there, Mr. Davis, and I hope that explains that to you. Okay.
Larry, while you're looking, can I just, a couple of people have
Yeah.
emailed us in asking about nuclear energy ETFs, if you can recommend something about nuclear energy. And the other one
Sure.
is a military industrial complex.
So let's have a look at URA. So this is the ETF that I use for uranium. I tweeted out recently, it was probably in here, it may have been in here, that uranium was one of my favorite trades. We had come back to the 200-day average. It was probably one of my weekly picks, and then it failed. And you look at it and you say, well, why did it fail? And so what goes on in underneath the hood in all these things, and what drives them? You know, policy. And you know, today, the worry about Russia going into Kazakhstan. Kazakhstan supplies, what is it, 30 or 40% of the world uranium, some massive number like that. So, you know, does Germany now turn back on the nukes given the reality that they're burning more coal today and they're a worse environmental polluter today than they were 5 years ago before they made the decision, you know, after Fukushima, to close down their nukes and get their energy from France, who uses nuclear. I mean, the hypocrisy and the stupidity of some of the decisions that are made are staggering. But, you know, I think uranium is part of the green solution. Brussels passed a resolution. I believe it's resolution form, it's not a mandate, that nuclear is part of the green solution where it wasn't considered before. That gives the green light for nuclear build out and development. But it takes, I don't know, 5 years to build a reactor. So it takes a long time for the stuff to come on stream, and it takes a long time once you shut it down to get it going again. And so the demand will be there, but it's really more about price. And so, you know, we should get a decent rally here, at least back up to the $30 level. We were trimming some exposure there. I added it back against the 200-day. I haven't added since. I did add some Cameco exposure recently. When you look at this ETF and you look at, you know, what's in it and what makes it move, you can see that you've got, you know, small producers, big producers. You've got, you know, all kinds of things, you know, in here. But it really, it's a great overall uranium play. You can see that the Kazatomprom, you know, was down big today, right? Anything related to Europe was hit. Where we saw big recovery in North American names led by technology. In general, you saw emerging markets in Europe generally stay weak. One of my favorite plays that I've been in for quite a while is Ciba and Stillwater. They've got some exposure to uranium in South Africa, I believe. Cameco, obviously a big mover today. So this is how I play uranium. And Cameco is the Cadillac. It's my go-to name. I don't get into the juniors. They're less liquid. I need to move bigger sizes. It's too difficult for me to play the junior names. So I stick to the liquidity providers. And so I go to the Cadillacs of the industries. It's going to be different for you and how you trade. If you're trading a couple thousand shares versus, you know, hundreds of thousands or millions of shares, it's a different lens. So here's a question here. Given the turmoil in the world, how much further do you think the markets will drop? Do you think gold will move higher? You know, bring out your crystal ball. So I talked a little bit about gold already and the markets overall, and we just don't know, Lisa, how far we can fall. Wind back the clock 2 years to March of 2020, and I was telling everybody in April and May, this is a bounce and we're going to get another move lower. And guess what? I was very wrong. It didn't happen. Why? Because you got a colossal, mind-numbing amount of money coming in from everywhere in the world, and central banks buying all the paper. So there was no stress to all that new debt, you know, pushing interest rates higher or anything like that. It was colossal, and I fought the Fed, and we should have got more of an economic downturn, and we didn't. So that argues that how fragile the world is, and so hit by a shock could go a lot lower. But to me, that next shock would be a policy mistake by the Fed, meaning causing a US recession by tightening too much into a weakening economy and a fiscal cliff, despite inflation pressures going up. So what inflation does in the next couple of quarters is monumental. It's equally as important to what happens on with Putin and Russia and NATO. And I would put those up there. And I would, for now, I think China is less on the front burner. Don't forget about it, because the technology war with China is very real, and onshoring of supply chains is very real, and what that means for Chinese growth is very real. But China faces a major demographic headwind, and that demographic headwind is the aging population and their one-child policy, and the imbalance between male and female. So based on the latest data that I've seen, there's about 70 million more men than women in China due to their horrific policies. And therefore, because they don't embrace immigration in China, you will see net people leaving China, particularly men to seek family in the traditional sense of the word. and they're on average about 43 years old. Japan's the oldest economy, Germany's second. There's a few others like Italy that are up there too. But in terms of large economies, China's 43. They are facing Japanification in terms of their natural rate of growth by population. You take that away, and the only way you can grow if your population isn't growing is through productivity. Make no mistake, the number one thing for China to grow is productivity enhancement through technology. Make no mistake about that their investment there and their protection of it and their theft of IP is going to be, front burner. So they're going to let their technology companies thrive and grow, but they're going to be very mindful of the social impact of their power in the Western markets. Okay, and Alibaba doesn't need to grow in the US. It can grow in Asia. It can grow where China wants to be the central bank digital currency of Asia, and that half of the world, maybe including Europe, maybe not. There could very well be an East-West divide that develops in the coming decade if other economies embrace the Chinese central bank digital currency as the means of exchange. And make no mistake, China wants that. It's part of their Silk Road initiative. This year in October, their next plenum is up, and it's all about planning and looking good. And they're going to turn the economic taps on, and Chinese market should outperform U.S. markets this year. And I've got positions there, and I think Chinese tech is the way to play it. So I don't know if that answered your question, Lisa, but I did cover where I thought the downside risks are for U.S. markets, and it's probably 36 to 3,800 is your worst case scenario there. Lawrence is asking, is the hedge and non-hedge still a little hazy for me? I think the Canadian dollar is undervalued. So my ZPay went up 1% today as the US dollar went up, where the ZPayF went down. Is this mostly currency driven? It's all currency driven. Lawrence, the only two differences between those funds, they have the identical underlying holdings and exposure from a market perspective, and the difference is a forward contract that's hedging the currency back to Canadian dollars. So as the Canadian dollar moves around, that's going to define the difference between the two of those, plus or minus the cost of hedging. Sometimes the cost of hedging is a plus, sometimes it's a minus. It all depends on the rate differentials between the currencies you're hedging. For example, now you actually get paid to hedge your currency exposure relative to Europe because rates there are lower than they are in North America. If rates were higher, it would be more expensive to hedge. Rates are very similar in Canada, the US, and the cost of hedging is pretty nominal these days, although you're paying a spread, a bid-ask spread to do the hedge. Let's see, what else do we have here? I notice my weekly updates on my funds, which I own, are not being published anymore. Will they be continued? Well, I'll look into that. That's obviously a bottleneck somewhere on ours. We did recently revamp those reports. BMO made a request to us, and obviously the person who's responsible for the distribution of those somehow got restructured. So thanks for pointing that out, Mark, and I'll make sure those get continue to get published. Another question on gold. Do you agree with the do you agree with the phrase In chaos, there is opportunity. So Louis, or Louis, however you pronounce your name, yes. So buy when there's blood in the streets and so forth. But sometimes we have to be a little bit thoughtful of what causes the chaos. And I'll wind back the clock a little more than 20 years. I was a strategist at CIBC World Markets, and we did a daily video for clients, where I would come on or another strategist would come on and talk about what's going on. And, I've been doing these sound bites for so long, and giving people thoughts and advice and guidance of what's going on. And so 9/11, and I get on, the morning after the markets open up again, and I had tears in my eyes. What do you tell people after something like that in terms of how to profit, right? And so, when there's a war and there's a tragedy and it causes chaos, there's opportunity, absolutely, but you got to be mindful of how you discuss it, and because there's tragedy going on, and so war is never a good thing. And it part of my value system, trigger, is very uncomfortable in markets like this. But my fiduciary duty is to investors, and governing their assets that they've entrusted me with. So, I do approach it with that lens, but I'm mindful of the social consequences of that. But thanks for that question. And in general, I agree there's opportunity in chaos, mindful of the social connotations. So Ukraine crisis seemingly like the initial catalyst, as you alluded to. Valuations are still lagging the pending structural risk of the financial system. I think there's definitely some risk there. We are in a new Cold War, measured in as long as Putin's alive, and the next, leader behind him supports that notion, will yet to be determined. But it looks like he's going to be there for a while. I wrote in my notes to our internal financial planners and partners today that the black swan here would be an internal coup in Russia, recognizing that Putin's bankrupted his oligarchs if they're invested in the Russian banking system. Now, maybe he told them all this was coming and they all shorted and hedged, and who knows, but he needs the support of the money and the power people under him and beneath, and so that'll be interesting to monitor, and I've kind of got a lens on looking for that kind of information out there. So that would be a black swan, and if Russia really doesn't want this, it appears they do. It appears that Putin's well liked, certainly more than Biden is in the States at this point, if you believe some of the numbers. It seems like financials got hammered today. Why? Well, they did, because there's that uncertainty of credit and financial systems, and money flowed to liquidity and big cap tech, and the earnings are going to be there, and the yield curve flattened, and that's bad for bank earnings. And systemic risk, if there's sanctions in banking and one bank has problems because of it and they can't lend, and so there's those credit risks that creep into it for sure. But I think the stagflation environment should keep the yield curve steeper and prevent it from inverting, and I think you want to buy dips in the banks from that perspective. Let's see. Over the years, have you proven to be a leader in educating the retail trading investor? Thank you. Oh, well, I thank you, and I take pride in that. I really, when BNN first started, the last thing here, because we're out of time, in 1999 at ROB TV, I was on the Wednesday show of Market Call. And after a couple of years, the head of BNN came to me and said, when you're on, our ratings are 50% higher than average, and we want to feature you on a regular basis. And ultimately, a number of years later, Berman's Call was born, and again, celebrating the 15th anniversary of it. I think the reason it's so successful is you guys and the viewers, and you like what we have to say, and I think you appreciate our unbiased, although somewhat clouded judgment around political influences. And but I do try to educate Canadians. I do want investors to make better investment decisions. It bothers me to no end when I get questions of people averaging down, making huge bets in one area and really putting their financial futures at risk because of emotional influences and speculation, and have nothing to do with good investment decisions. And really, I've made that part of my mandate to try to help people to do it a little bit better. So everybody, thank you so much, for attending tonight. And if you can support one of our charities, I'd be thrilled to match your donations. And if you are interested in some of our partners and what they do, and if you're investment advisors out there, please have a look at the Q Wealth platform. It might be something that you're very interested in. It is the next generation of helping people manage their wealth. Have a great week, everybody, and tread well in markets.